Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimezi Obi Iwagu. On the show today, FBN Quest Nigeria Manufacturing Purchasing Managers Index picks up gently in June from 49.2 to 49.8. And South African manufacturing activity weakens again in June. Plus, IMF projects 6% growth for Benin Republic's GDP this year. We'll begin here in Nigeria as the Purchasing Managers Index picked up gently in June from 49.2 to 49.8. And this is according to a report by an investment bank, FBN Quest. The reading, which is based on manufacturers' responses to set questions, shows decline in 2 of the 5 sub-indices, with 3 now in negative territory, including output, employment, and stocks of purchases. The manufacturing sector appears to have stabilized given the access to foreign exchange as a result of the CBN's monetary policy reforms. And to the market now, the Nigerian market was on the negative zone at intraday, down 0.17%. The JSE index was also down 0.80% following a decline in business activity in June, pointing to lingering weakness in Africa's most industrialized economy. South Africa's new president, Cyril Ramaphosa, is trying to reverse a decade of economic stagnation under his predecessor, Jacob Zuma. But recent economic data, including first quarter gross domestic product and mining output, have disappointed. South Africa's seasonally adjusted Absa Purchasing Managers Index fell to 47.9 points last month from 49.8 in May amid declines in new orders, business activities, and employment. In the meantime, Egypt was up 0.15%, while Kenya was down 0.02% on Friday. And in the Middle East, Dubai fell the most amongst the markets, and the index was down 1.23% at intraday. Abu Dhabi was down 0.95%, Saudi down 0.83%. However, Qatar bucked the trend to trade up at 0.31%. And in Europe, shares traded sharply lower in early trade as investors questioned the stability of the German government and wider trade links between the European Union and the U.S. Well, let's bring in my colleague in Frankfurt, Conrad Busen, to tell us more. Hello, Conrad. A beautiful week to you. Good afternoon.
Good afternoon to me. It's good to be back on Channels TV.
And it's good to have you back. Now, the European stocks underperformed Wall Street as developed markets in the first half of 2018. Are investors' patience with European equities wearing thin?
Sort of, Jimmy, sort of, yes. The German share index, DAX, for example, has lost around about 6% nearly in the course of the last 2 trading weeks. And of course, clearly the concerns about the ongoing trade battle between America and Europe, but most of all between America and China, is taking its toll here, as our economy here in Europe, especially the German one, is so intertwined, so interconnected with especially China. And we've been getting negative purchasing managers indicators today from China, also from Japan, that indicate that some impact of the ongoing trade battles is already be seen in the data coming from the purchasing managers in China. And adding to all this, you mentioned it, we have the political risk here in Germany. We have an ongoing dispute in the European Union about how migration policy is handled. Even after last week's European Union summit, where Chancellor Merkel negotiated quite a few solutions how the problems can be tackled on the European level, political partners of the Chancellor here on the national level are not happy with what came out of this summit. We have an interior minister who threatens to resign, and some pundits even believe that the whole government could be at risk. This, of course, is not the stuff that investors like if you want to convince them to get and invest into company shares. And this contributes to the, well, very jittery trading day we have here today. The DAX is not so far down as it was when trading started this morning, but still it's on the downside. And of course, this is not a day where investors are getting into shares.
Well, it's the first trading day in the new quarter and, of course, the second half of the year. So tell me, what is the playbook that investors and traders are looking at for a cross-section of assets in the second half, from stocks to bonds and currencies?
Well, one question, whatever the asset is that you're focusing on, is, of course, about monetary policies. And not only here in Europe, but of course on both sides of the Atlantic Ocean. In the United States, the question is, will Jerome Powell and his colleagues of the Federal Reserve Board, will they increase the federal funds rate, the key interest rate for the United States, one more time this year, or maybe two more times? This question has huge implications, not only for the United States, but also especially for many emerging economies, which rely so heavily on the US dollar when it comes to debt making. And also, of course, if interest rates in the US rise further, this will have an impact on government bond yields, which is likely to make American government bonds more competitive compared to other government bonds worldwide. And that might become a problem for some of those governments, especially of emerging economies. Here in Europe, of course, the question is also what we can expect in terms of interest rates, as the European Central Bank sort of has indicated an ending to quantitative easing. And as well, of course, this will have a strong influence on how, the attunement between the different stock markets, but also between the different asset kinds will happen during the next 6 months. Then, of course, what's going to be very important is the political question in Europe. I mentioned what's going on in the European Union. We should not forget Brexit, which is coming closer and which is yet to be negotiated. Also, I can say that in terms of the economy, the fundamentals remain strong. We've been getting a few warning signs of not so strong economic dynamics recently, but basically the businesses here are operating well in Germany, and so there's reason in terms of economics not to be too pessimistic.